Welcome to our third video on the topic of market microstructure. I'd like to talk about a third type of order, and this is referred to as a stop loss order. The visual on this one is pretty informative. It might look like this: buy 200 XYZ, stop 2010. Okay, what's this mean? Well, it's some sort of a buy order. 200 shares, underlying stock XYZ. Now, what's this? What's the stop price? Well, this is how this works. Let's say right now the stock is has an ask price of 1920 and a bid price of 1918. Okay, we'll assume those are the current quotes. Now, maybe the person that placed this order had originally short sold the shares. Okay, when you short sell shares, your broker on your behalf borrows shares, and then you sell those shares, thereby locking in the sell price. But you owe shares. You have a share-based loan. So at some point in the future, you will want to buy back those shares. We say you sold to open your position. Therefore, to zero out your position, you have to buy to close. That's short selling. You can only short sell in margin accounts. Okay. So this person may have done this, and he did this because he or she thought the price of XYZ was going to fall after he sold short. Okay, so that happened a while ago. Now let's jump back to the future. Where we have this stop loss buy order entered. So what's he thinking? Well, perhaps he sold this stock at, let's just make up a number. Let's say he sold the stock at 1980 a share. That was the price at which he sold the shares. He sold to open at 1980. So his position in his brokerage account would look like this: XYZ, and the position size minus 100 shares. Okay, that's what you'd see in his brokerage account. So to get to zero, to close his position in XYZ, he or she would have to buy shares, 100 shares. And again, he sold it because he sold to open because he thought he could buy back later at a lower price, right? And then maybe he was thinking the stock price would go down to $16. But the reason he enters an order like this is because he's fearful that if the stock price rises from the 1980 price, okay, he's fearful that if the stock price rises from that price, he's going to lose. Because remember, this is his sell price, right? And in order to zero out his position, he has to buy to close. So he's looking for a buy price. The only way you make money is if your buy price is lower than your sell price. And so maybe he thought it was going to go to 16, but if it starts rising, it means he was, at least in the short run, wrong, and he or she may choose to close their position. And this is an interesting order, this order right here, this stop loss order. So what it means is, and again, we're entering this order at a time when these are the quotes. Okay, we're going to assume those are the quotes. So the stock started moving as he had expected. He sold at 1980, and price is down. Right now, you could buy to close at 1920. He thinks it's going to go to 16, or so our story goes, and he enters this order. Okay, so what this says is that basically he or she is saying, if I'm wrong and stock price rises, once it hits 2010 a share, then I'm fearful that it's going to keep rising. So right then and there, I want to buy to close. Okay, I'll take my loss. In this case, I'll lose 30 cents a share. I sold at 1980. I'll buy at 2010. I hope I'll buy at 2010. Okay, and that's what's happening. Now, technically, we have to realize that what happens is this order, this order right here, this stop loss order is really a contingent market order. It's a contingent market order. Okay, and it's contingent upon the price in the market for the stock being 2010. In other words, a trade has to occur at 2010. Your broker may allow you to set these orders with respect to a specific bid or ask. In the general context, that would just be a last trade price. Okay? So it's a contingent market order. So it's important that you remember that a stop loss order is a contingent market order. And what that means is if the stock trades at 2010, then this order is going to immediately morph into a market order to buy 200 shares. Okay, buy 200 XYZ stop 2010. And what triggers it is if the stock trades at 2010. So again, if this person is lucky enough to get to buy the shares at 2010, remember, it could be worse. The stock price could keep rising. But if he's lucky and he gets to buy them at 2010, he'll lose 30 cents a share. He bought at 2010. He had previously sold at 1980. Okay? So now let's look at another type of stop loss order. This is simply the sell order. Okay? So it might look like this: sell 500 JHG, stop 1550. Okay, and so this is a sell to close if it actually executes, and so he he must have bought to open. So what story would go with this? So maybe he bought JHG a long time ago for $12 a share. So a long time ago he had 500 shares of JHG that he paid $12 per share for. Okay, and maybe right now the ask and bid for this stock are, let's just assume, asking 1605, bidding 1604. We'll assume those are the current quotes. Okay? And so right now he's got over a $4 a share pre-tax gain. And why would he then enter this order? Okay? Now, it's not a limit order, because if instead of stop, if this had said limit, it would immediately execute and he would sell his shares at 1604 a share. But it's not a limit order, it's a stop loss order. And you notice you kind of set it when the current stock price was on the opposite side of where it would be with a limit order that would execute. Okay? So, let's, what would justify this? What type of rationale would make this logical? Well, if the stock price is at 16 and he's not selling, he must think the stock price is going to continue to rise. But he or she's smart enough to realize that they might be wrong. And what this order implies is that if indeed the stock price starts to fall, he doesn't want to sell it for much less than $15.50. So if the stock price trends down and it actually trades at $15.50 a share, then this order will transform into a market order to sell 500 shares. Remember, market orders have no restriction with respect to price whatsoever. So it would just, as soon as the stock trades at $15.50, this order morphs into a market order to sell, and he gets whatever the best price is for someone wanting to sell, which will be the bid price. And it may very well be $15.50. It could be lower, it could be higher. But it's generally going to be around $15.50. And so someone might do this if they were trying to perhaps protect a significant portion of their gains that they'd previously earned. So that's stop loss orders. And again, it's important that you realize that a stop-loss order is a contingent market order. Now, I just want to make brief mention of the fact there's another order called a stop-loss limit order. Okay, stop-loss limit order. And this order is a little different. It's actually, rather than being a contingent market order, it's a contingent limit order. And all this does is it says if the stock trades at a specific price, that a limit order to buy or sell is then immediately entered as opposed to a market order. So a stop-loss limit order is a contingent limit order. Contingent upon what? Contingent upon the specified stop price being a price at which the stock trades. Okay. So that is all I have to say about order types. So just to review, we saw 4 types of orders. The first was market orders. Market orders have no restriction on price. You're basically saying I want to buy or I want to sell at whatever price exists whenever my order arrives. Second type of order is a limit order. Okay, limit orders restrict price. If you're buying, you want to pay a certain price or lower. If you're selling, you want to receive a certain price or higher. Okay, and there are 4 types of limit orders that we looked at. You'll remember those 4 types. Third type of order we just looked at was a stop-loss order. And you have to know that a stop-loss order is a contingent market order. And the 4th type I mentioned is a stop-loss limit order. And you have to remember that this is a contingent limit order, contingent upon the stop price being a price at which the stock trades in the market. That's all I have for this video. Thanks for watching.